Hi folks, Matt from Stock Trades here. It's been a wild couple of weeks, hasn't it? We are in the midst of one of the fastest declines in market history. At no point has the market been this volatile. It used to be a 1% swing on either side was a pretty active day. Now we've seen several double-digit swings. That's unheard of. These are times of unprecedented volatility. Can't say that enough. So where do investors go from here? Retail investors are asking themselves, should you buy, hold, or sell your stocks? We'll answer those questions and finish by giving you 3 investment options for those who are looking to buy. Let's start with the first question. Should you sell your stocks? At this point, it's not the best course of action. Let's be frank, the best time to sell was last month, before the downtrend began. Now, we're looking at losses of 35% plus. Now is not the time to sell. You don't make money by selling at a low. It's best to either hang on, or if you have cash on hand, you might want to consider viewing this as a buying opportunity. Which category you fall into depends on many factors. Are you at or near retirement? Are you just starting out? What's your risk tolerance? Are you a high-risk individual or low-risk? Do you need to cash out your investments to make a short-term purchase? Are you dependent on that money for your day-to-day living? Are you one of the 1 million Canadians who have recently filed for unemployment? These are all questions that you need to be asking yourself. We can't answer those questions for you. Every individual has a unique set of circumstances that will guide their investment decisions. However, for those that are looking to buy, we have 3 stocks for you. 3 stocks that are worthy of your consideration. Let's start with the first one, Dollarama. Dollarama has been rock solid throughout this downturn. Over the past month, its share price has only dropped by 5.5–6%. That is significant considering the TSX index over the same time period has lost 30% of its value. We expect this outperformance to continue. Why? First off, Dollarama has been one of the major beneficiaries from all this COVID-19 panic buying. Call it what it is, it's panic buying. People have been flocking to their stores to stock up on supplies. So that's catalyst number 1. Catalyst number 2, they have also been deemed an essential service in Ontario and Quebec, who both announced lockdowns over the past couple of days. As an essential service, they are allowed to stay open. This, once again, will help the bottom line. The longer they can keep their retail stores open, the better. Midterm, a recession is almost a guarantee at this point. Experts across Canada, across North America, fully expecting a recession once we come out of this COVID-19 crisis. Given this, Dollarama is well positioned to benefit as a low-cost option for consumers. Long term, this is still a retail company that is expected to grow in the low single digits. Although the high double-digit growth from years past are in the company's rearview mirror, they still have lots of opportunity to expand. They have also expanded in Latin America and have big plans for that area. Once COVID-19 subsides, Dollarama is still positioned to grow. After a valuation reset in 2019, we believe that Dollarama offers excellent value in today's environment. Next, let's talk banks. Canada's big banks own some of the longest uninterrupted dividend streaks in the country. This alone makes them worthy of investors' attention. In fact, they are the most widely held securities across all pension plans in Canada. One of our favorites is Royal Bank of Canada. There are a number of reasons for this. First, the Royal Bank of Canada continues to hit multi-year lows. It has been this cheap since 2016. Not only that, it is now yielding above 5%. The last time it yielded above 5% was the 2008-2009 financial crisis. It didn't last long then. Don't expect it to last long now. I know what you're thinking. What about all those payment deferrals around COVID-19 strategies? Should you be worried? In the short term, yes, it will have an impact on banks. It's quite frankly going to have an impact on everyone. The important point to remember is that COVID-19 virus is temporary. The spread will be mitigated and eventually life will return back to normal. At such time, the banks will in fact receive their payments. Remember, these are payment deferrals. They are not payment forgiveness, and it's an important distinction to make. At some point, the banks will get their mortgage payments, they will get their credit card payments once everybody is back and living their normal lives. This is not a complete forgiveness of mortgages or credit cards or insurance payments. Are you worried about oil and gas exposure? Don't be. Once again, the banks are well diversified. For Royal Bank, oil and gas portfolio accounts for less than 2% of outstanding loans. Sure, it'll hurt the bottom line, but it's not catastrophic. Lastly, you might be concerned about credit card debt. I do believe that is probably one of the bigger concerns. Canadian consumers are highly indebted. However, it's important to remember, Canada's banks, actually banks in North America, are much better capitalized than during the financial crisis. So they will be able to navigate this downturn. Canada's banks didn't cut the dividend in 2008-2009. I don't expect them to cut them in 2020 or 2021. Now, dividend raises might be suspended for some time, and that's okay. The important part is the dividend is well covered. They are safe investments. Our third and final stock is Telus. We are really attracted to telecoms right now. Given what's happening with COVID-19, hundreds of thousands, if not millions of Canadians, such as myself, find ourselves working from home. Telecoms provide critical infrastructure to make this happen. They are the leading providers of internet service. They are the leading providers of cellular data. All of this will be critically important to ensure that those who are able can work from home. Although telecoms have been doing their part, removing data caps, providing unlimited internet, don't kid yourself. Working from home will be a boon to these telecoms. It is in their best interest, and they will profit from it. Now, you might be worried about the federal mandated price cuts, which are going to require telecoms to reduce our cell phone bills by approximately 25% over the next couple of years. I wouldn't worry too much. The mandate only applies to those lower data plans, which account for a very small fraction of Canadian cell phone bills currently. Telecoms will make up the price difference elsewhere, making this a non-event. Why Telus over BCE and Rogers? While all three make good investments in their own right, we like Telus for the dividend. At 5.5%, its yield is now one of the highest it's been in history. The last time it was this high, much like RBC, was during the financial crisis. Secondly, it also has the longest dividend growth streak at 17 years and counting. This dwarfs that of the 11 years by BCE, and Rogers isn't even a Canadian dividend aristocrat. It actually went through a multi-year period of dividend stagnation as it was dealing with high debt loads. So Telus has been the most consistent. It has the longest dividend growth streak. It has one of the better coverage ratios, and it has also grown the dividend at a higher clip than either Rogers or BCE. This is what, in our view, what sets Telus apart. And that does it for today. To recap, our three top picks are Dollarama, Royal Bank, and Telus. We believe that all three provide excellent value today, over the short term, mid-term, and long term will make excellent investments for the retail investors. Be mindful, however, we are still in a period of unprecedented volatility. So with that in mind, we encourage investors to average into positions. Slowly build your positions because you don't know what the market's going to do today, tomorrow, over the next week, couple of weeks. Expect considerable volatility. So that's it for today. Please like, subscribe to our channel so you can get access to more great Canadian investing content. Till next time.